so much of what we see from these sort of financial influencers on TikTok and Instagram, these uber risky asset classes, these get rich quick schemes. And when the music stops, people get really, really badly hurt. So it's important to be excited about investing. You want to make money, of course. That's a foundational must have, but you've got to teach kids that there are cycles and there are things that happen that cause some of these things to go to zero. And diversification is so key, even when you're young.
Welcome, everybody, to today's episode. Today, we are going to be diving into investing with your kids. There's a lot of talk about investing for your kids and for future generations, but today we're actually going to dive into how to have your kids be well prepared, how to have them be financially literate, and then to excel their investment career from an early age. So today we have the pleasure of being joined with us by Doug Allan. He is a phenomenal CPA. But honestly, his expertise spans a whole breadth of topics outside just being a CPA. So Doug, welcome.
Thanks so much for having me.
Absolutely. So before we kind of dive into today's topic, can you tell us a little bit about your story, how you got to where you are, why financial literacy, and especially for kids, is such an important topic for you?
For sure. I come from a sort of entrepreneurial family. And so when I went to university, I went right into business. And got into the finance and accounting world, as you mentioned, becoming a CPA. Today, I work in real estate development and investment. And so I've kind of had this advantage in my educational and professional career that's given me a lot of knowledge that helps me with my personal finances. And I found that was an imbalance, that most people who don't take that path through education and finance and business still have the same decisions to make around their financial futures, around investing, around borrowing, around saving. And so educating people from what I've learned is important to me. And I'm, on top of that, I'm a father of two kids, 7 and 10 years old, and they're growing up in a world where there's no financial literacy education in the school program. So it's really upon parents to do that for their kids. And so a couple of years ago, what I did was I wrote a book for kids to effectively replace what I think should be in the school program.
Interesting. Yeah, I mean, we consistently hear, at least from my conversations with investors, two things when it comes to investing is, hey, I wish somebody taught me this earlier in school, in high school, even in middle school, even as something as, basic as taxes. What, how are taxes calculated? What effect do they have? How can I minimize my taxes? And the second thing I hear is, hey, I feel like I got into investing too late. I wish I had got investing, when I was younger, when I was in my 20s, truly kind of, hit home that compound interest, which I'm sure we'll touch on later in the discussion.
100%. Yeah.
But do you feel like there's an appropriate age to really kind of introduce the topic of investing or financial literacy or financial growth? Is there ever kind of an age where kids are too young to really fully understand, or what kind of would be the ideal age to really introduce the topic?
I've explored this a lot with my own kids, and I find once they get to even 8, 9, 10 years old, they become interested in the world in general and what's going on around them, what's happening with money and news and so on. And so that's when I start to really introduce a conversational approach to talking about money, finance, investing, real estate even, and they start to absorb it and ask questions. Younger than that, they're just simply too young to care, too young to be interested. But once they're hitting, grade 4, grade 5, grade 6, this becomes real, and then they start to be exposed to more of those real life concepts. So you can never start too young, as you say, to build those foundations such that when they get to high school and they get to university and beyond, they're much, much more well equipped with knowledge.
Yeah, very interesting. Great. So what effective strategies to kind of introduce the topic would you suggest? And, how can we tailor the approach for different age groups depending on when we kind of introduce the topic of financial literacy and financial knowledge and kind of growing your investments?
Yeah, it really depends on the age you're talking to. I find when they're really young, they're in elementary school sort of thing, you really want to keep it pragmatic to what they're used to. So you're out grocery shopping, you're talking about prices rising. You're at the gas station, you're talking about the price of gas per liter. Talking about how these prices have gone up recently because of things like inflation, and they sort of ask questions, what's that and why is that happening? Practical. And And then, later on when they're teenagers and they start to be able to be pretty close to opening up an investment account, then you can move into more sort of complex topics like investing and ETFs and real estate and stocks and bonds and all the different sort of complexities of the investment world. But I find sort of a foundational approach is really important in understanding, how money generally works and where it comes from and where it goes and how things are priced and, what you can spend money on and where you earn it. That's foundational first.
Yep. I mean, it's even the case for most investors, right? Is to explain topics in a simple but easy to understand, methodology. And a lot of that comes from analogies and stories. I was playing around with ChatGPT, I know it's kind of the buzzword nowadays with AI, but I was playing around with ChatGPT and I was asking different questions. And I was trying to have it respond back to me and say, hey, take this really complex topic and explain it to me as if I'm a 5-year-old or as if I'm a 10-year-old or as if I'm in 5th grade. And it can take a certain topic, still keep the contents of it, but really kind of tailor how that information is delivered to, I guess, me or to kids or to a different audience, which is really neat, right? So if you have this like kind of big topic of, right, why are taxes so important in real estate investing and how do they kind of affect your bottom line kind of net cash flow? That's all kind of terminology that may not resonate with kids, but if you plug that into an AI software or ChatGPT or some other kind of language learning model, it can kind of give you a format for how to explain it to your kids or to your kids' friends and kind of their whole kind of cohort. Because that's ultimately the whole goal, right? Is you don't want to just educate your child. You want to have kind of a full, I mean, again, Doug, I don't know if this is kind of your plan, but to kind of fully revamp the educational system to actually provide a substantial, financial literacy, almost curriculum, if you will.
100%. And I think, you're right that it's important to find it, find ways to explain these concepts to younger people that don't have the same level of knowledge that we do. But I find at the same time, topics are being taught to these kids like algebra and calculus and geometry and relatively complex topics, and they're able to absorb the knowledge more than you'd expect. The fact that I can talk to my 9-year-old about inflation and how certain governments are impacting finances and GDP growth and jobs, they listen and they learn, and as they get older and older, I found even going into classrooms in grade 10, 11, 12, where certain schools do have some sort of investing clubs. These kids are talking about options and forwards and futures and derivatives and crypto, and that they're able to absorb the knowledge. So you have to also keep in mind that they're very capable. So you don't want to dumb it down too much. But
yeah,
the real life examples are so important, and on the level of a 16-year-old who the most coveted thing they could get is, say, a new Xbox or something, right? That's $1,000, $2,000. If you put that in perspective to them and you say, hey, if you buy the Xbox now, great, you'll love it. It'll be super, super, important to your daily life. But you do have an opportunity cost to that. There is something else you could do with that money. So just know that $1,000 now, if you had invested that, let's say, put it away for 40 years, you're giving up $50,000, $60,000, $75,000 later. So which is more important to you? How do you balance that out?
Yep. Yeah, that's a great point, right? To give kids credit, because I think even when they're, babies, right? Obviously not going to be teaching, stock options to babies, but even when they're young kids, right? They have this innate kind of ability to understand what you're talking about, even if you think it's too complex a topic, right? There's this one great example by Patrick Ben-David, who's this entrepreneur, really kind of well-versed, smart guy. What he did with his kids was he said, hey, there's this kind of, to your example, there's this Xbox that you want, right? In his example, his kid really wanted the new Lego Millennium Falcon, but
cool.
He said, hey, we could buy this for you, but there's no kind of inherent reward in that, right? And it doesn't teach you to really kind of work and kind of have that delayed gratification. So he said, hey, our currency in our household is books. The amount of books that you read will get you different rewards. So he said, hey, this is kind of a really big, reward. This is going to cost 20 books. And so what he did was he instilled kind of that currency as book reading, but really it was learning and to have that kind of constant, never-ending improvement kind of mindset to ultimately then, after your 20 books, be able to get your reward, but at least have some sort of kind kind of educational component tied to the rewards, kind of like what you were saying with the Xbox as well.
Makes sense. Yeah, I reward my kids for good grades as well, right? If they can get the same grades as last year or better, then they get something as a reward. Hard work pays off for sure is a foundational concept to life in general.
Yep. Yeah, fully agree. Can you kind of give us some real life examples, ones that you've either talked about in your book or one that you've taught to your actual kids, for kind of those real life examples of illustrating, financial concepts?
For sure. Yeah. And I talk to my kids just all day, every day about topics like this. And I think one of the main things to get across, I think that's really important is that talking about money and finance with kids has long been this sort of taboo topic that shouldn't be talked about. And it's sort of behind closed doors. And that's resulted in generations of families that don't talk about these issues, don't know about these issues, and the financial disaster occurs. So I try and just have a very open and transparent discussion around the dinner table with my kids about what's going on in the world, hot topics. I'm from Vancouver, Canada, so for us, the housing market is almost a sport, and it's a topic of conversation at every cocktail party. And so my kids will ask about what's going on in the housing market. Are prices still going up? We'll drive by a house with a for sale sign, and they'll go, "Hey, Dad, I think that house is what, 2 million?" Right? So they have immersed themselves in the topics because I talk about it. I'll talk about an investment that I made or I exited and what went well and what didn't go well. And they'll ask about it. What was it like? What did you invest in? I'll talk about how certain companies are doing certain things. A good one for kids is movies, right? They love Disney movies. So instead of just going to the movie, I'll talk about this was Disney's budget for this movie. Here's what they had to pay all the actors and the voice actors. Here's what they have to earn from ticket sales to make this thing actually make money. And I understand the business of the movie as opposed to just going to watch it and spending the money on the ticket and it being a sort of consumable experience.
Yeah. No, that's awesome. That's really cool. Yeah, I mean, that's really cool. Right? To connect the topic that you're learning about, whether it's financial literacy or investments, with something that you actually care about. I think that holds true for kids. It holds true for adults. Same thing when we're talking to physicians or attorneys, we try to kind of link that investment jargon and terminology back to something that they're already know and are familiar with, because it makes that learning process so much easier, right? So yeah. Let's take a step back. What are kind of the key principles that you'd want to teach your kids to ensure they kind of have that balance between, consuming and then saving for long-term financial goals and investing? So that can be kind of, hard to balance, especially with kids who tend to be a little bit more impulsive. How do you kind of strike that balance between those two?
Yeah, for sure. And there comes a certain age, it's probably, middle of high school, where you can get into some of these really important foundational concepts. But there's three that I always start every high school presentation on, every discussion with someone who's 16 or older on, that form the foundation for all of your financial decision making. First one is just the power of compounding and the power of time, because I think a lot of people have the approach of saying, look, I'm young, I'm 18, I'm not retiring until I'm 65, maybe 70, who knows? It's so far off that I'll just deal with this once I get a great job, I start making great money. I want to live in today, I want to spend money, I want to travel, I want to go out to dinner, I want to go to the bars. And that's just such a flawed way of thinking, but they don't understand the sort of the snowball effect that compounding presents. And I'll show them charts to say, hey, if you put $1,000 away now and you put it in a passive S&P ETF for 40 years, that's, say, I don't know, $55,000, $60,000 down the road. But if you wait 10 years and you only get 30 years of compounding on that single $1,000 investment, you only get 17 grand. So you sacrifice, tens and tens of thousands of dollars by sort of arbitrarily waiting, 10 years until you're more established to get started. And that is a jaw dropper usually, where they go, wow, I never would have thought that the contributions I make as an 18, 19, 20-year-old are the most important ones of my entire financial investing career. That's a big one. The second concept is around inflation. which is so topical right now, right? Just, post COVID, post stimulus, post money supply increases. But the idea that a dollar now is worth more than a dollar in the future, and things will cost more, right? And again, I talk to my kids now, and we go to the grocery store, and I complain, hey, $300 for groceries again this week. But let's say you're planning for your future and you're 35 years old. Grocery shopping for that same number of groceries in 35 years, 40 years, who knows? It could be $1,000 to go grocery shopping, right? Maybe more,
Yeah.
depending on how things go. So you can't look out in the future and try and project what life will cost in today's dollars. So it sort of reinforces the fact that as they invest, they need to take enough risk that their investments are growing and producing income at a rate that exceeds the erosion of the value of the dollars that they've put in. If they go in cash and they go in money market securities, they will literally get poorer, even though they're getting checks every month. And the third concept is opportunity cost and choice, of going, every decision you make, every t-shirt you buy, every concert you go to, every dining out experience you have, you are sacrificing something else by doing that. There is something else you could have done with that money that could have given you, wealth beyond what you think is possible down the road. So,
Yep.
You have to bring it down to those levels so that when they're living their life and they're going out with friends and they're doing things and they're buying things, in the back of their mind, they're going, what I'm doing here has a consequence. I can't see it now, but there is a consequence to my own financial future.
Yep. Yeah, that's key. That's absolutely key. And Einstein said that compound interest was the eighth wonder of the world, which is couldn't be more true, right? But it's interesting that when you have kids that are in those kind of early stages of the careers, that's really where, one, as you said, right, they have the most the power to invest, but also the more freedom too, right? When you're young, you don't have really the kind of life burdens, if you will, of family or careers or things that take away time and energy and potentially money as well. When you're younger, you have that flexibility to have a little bit more kind of risk in your portfolio, where you can afford to have a few more losses, as long as you have the right wins, so to speak. So
For sure.
when you're talking about opportunity costs and saying, hey, there is something else that you could be doing with your money, are you teaching kids essentially to say, hey, invest in assets, invest in cash flowing producing assets, and then use the income from those assets to really kind of fund your life? Or how are you having that discussion to say, hey, everything that you're doing right now has a cost, and it may not be the best method to really spend your own money at this current time. You really should be investing in investments to produce kind of a steady cash flow that then you can use to fund kind of your lifestyle.
Yeah, no, for sure. And going back to the Xbox example, I always say you can have an Xbox now, or you can have a BMW in the future, which is more valuable to you. And there's not always a right answer to it. It's really just the concept of understanding that there is a potential, awesome thing that you can have in a couple of decades, or there's a cool thing you can have now. So which one's more important to you? And there's always balance, right? You don't want to sacrifice all of your life's enjoyment now for the future, because none of us know what will happen in our lives. But it's really just the concept of it. And so putting it into those sort of terms, that is sort of these practical this or that, your choice, really helps put things into perspective. I don't typically go into, cash flow versus appreciation versus tax benefits versus, NASDAQ versus S&P versus whatever. It's a bit much, because everyone has a different investment sort of philosophy and strategy and risk tolerance, and that sort of stuff comes with a little bit of experience, which you can start to get into towards the latter end of high school.
Yep. And what are the kind of the most, suitable investment options for kids? Might be at different stages. And are there any specific considerations when choosing any kind of one of those vehicles to invest in?
Yeah. So the way it works up here in Canada is you have to be 12 to open up a bank account, have a debit card. And until recently, that was pretty uncompelling, right? You would sort of get this 0.01% interest on your money. Thankfully, interest rates have risen a little bit, so you can at least show your child that they're earning a little bit of interest as they put money away. And then as they turn 18, they can open their own investment account and get into, proper stocks and bonds and ETFs and funds and things of that nature, which of course you should do. It's interesting now that we've entered into sort of a more rate normalized environment, because, for the last 10 to 20 years, really, if you wanted a real return that beat inflation, most people are putting most of their money into stocks, equities, and bonds were relatively uncompelling. Money market was relatively uncompelling. But now, people can go out and they can buy a bond and get 5, 6, 7%. They can put money in money market GICs and make 5%. So the concept of diversification is a bit more interesting now, I guess, because there's actually decent investment returns from a lot of different types of asset classes. Mm-hmm. But certainly, as you alluded to, as you're younger and you have decades and decades ahead of you to invest, you can weather the volatility a lot more and take a lot more risk. But I would still caveat that with, so much of what we see from these sort of financial influencers on TikTok and Instagram is about crypto and these uber risky asset classes that are flashed around as sort of these get rich quick schemes. And when the music stops, people get really, really badly hurt. So it's important to be excited about investing. And you want to make money, of course. That's a foundational must-have. But you've got to teach kids that, there are cycles and there are things that happen that cause some of these things to go to zero. And diversification is so key, even when you're young.
Yeah. And are you having those conversations about real estate cycles and what causes them and how to pick up on them when they're about to occur? Or again, you kind of more so teaching them in the style of stories and things that they're familiar with? Like, when do you have that actual conversation and say, hey, now that you're actually getting ready to invest, you have kind of investment vehicle selected. Now let's dive into actual markets and ETFs and different stocks, real estate, different asset classes.
Yeah. And even when I talk to high school students, I always shy away too much from trying to tell them that they should be stock analysts, right? For them to realistically go and look at a company and review all of its financial statements, all of its disclosures, all of its management team, all of their history, strategy, all the things you need to do to properly do due diligence on a stock, times however many stocks you need to have in your portfolio to be properly diversified. It's unrealistic for most people to do that. It's sort of the keep it simple strategy of use well-managed ETFs, low-cost funds that have great, portfolios of assets in them that are managed by other professionals that, you pay a fee for that service. But if you're not a CFA or a CPA and you know how to read financial statements and you can figure out whether this is a good business or a bad business, it's pretty risky to sort of put them in that chair. And so I try and keep them, at the higher level of, here are the major asset classes, here are the different types of things these are exposed to. Real estate is an interesting one just because it's pretty simple. It's one of the reasons I love this business is there's a couple people that put in different types of capital, equity, debt. They buy a piece of property, it produces income, the debt gets repaid, anything left over goes to the owners. And so how things like interest rates play into that is something that's not that difficult to have a conversation with students, especially in Vancouver, where real estate is just sort of like dinner table conversation every day.
Yep. Especially on the multifamily side of things too, right? Like that, I feel like out of all the different asset classes within real estate, multifamily inherently just makes a ton of sense with, hey, you have people living, it shelters in a need. You have certain expenses, you have your debt, and that's how you calculate your cash flow. There's nothing really kind of too surprising on that front. Whereas if you get into, industrial or office or retail, there's a little bit more nuance, and especially more kind of terminology on the actual like commercial real estate side of things that I think might be a little bit of a harder bridge to gap, but not saying that's impossible by any means, right?
For sure, and keeping in mind that young people, they're not accredited investors, they're not buying into specific deal LLCs or structures. They're really focusing on the REITs and the publicly traded instruments, at least for now. Hopefully, they all become accredited investors one day if they follow the rules properly. But I agree. I agree. It's simple, and you can talk about things like this is a shopping mall REIT, this is an office REIT, this is a multifamily REIT, and this one's industrial. Do you think that people shopping online is going to grow? If you do, then you should not buy the shopping mall REIT. You should buy the industrial REIT because that's things like warehouses for Amazon and Walmart that will continue to grow with people buying stuff online, and that resonates with them. Do you think that people are going to be able to buy homes for themselves? Or do you think that people are going to struggle with that and be sort of forced to be renters for most of their lives? If you think like me that we're moving to more of a rental economy, then multifamily makes a lot of sense. These are high level strategic conversations, because at the end of the day, these investments should be longer term things. These are not day trades where it's like, I think this is going to go up in the next 2 weeks because of the Fed's next release. This is like, do we think these sort of secular trends are going to continue for 5 years, 10 years at a time? Which is long-term investing, and then they can get their heads around it.
Yeah, I like that. Right, it's really kind of simplifying it down so you don't get caught up in the jargon and all the details. It's saying from a strategic point of view, do you believe the real estate cycles that we've seen? Do you believe the inflation cycles that we've seen? Do you believe the deflationary periods that we've seen? Right, and if you are in agreement on those fronts, then if you find investments that align with that kind of overall long-term vision, then you're aligning your investments with your actual portfolio itself. Doug, are you seeing either your kids or kids that you've taught have these kind of conversations amongst themselves, or is it really just kind of coming from like kind of a top-down view where it's really kind of teachers and mentors, parents that are really kind of teaching the financial literacy? Or you actually say, hey, I've actually talked to my kids and I've noticed they're having conversations on their own about financial literacy and investing, or are you not seeing that in the conversations they're having?
I'll be honest, most kids are not talking to those amongst themselves about finance concepts. The groups that I've spoken with at schools are mostly clubs that are elective, where certain students are interested and want to get together and learn more, but it's elective. And it's not a topic for the playground, generally speaking. It needs to be introduced, but I think there's a lot of receptiveness to people like me coming in and helping them to learn, because frankly, the teachers in the high schools these days don't know what they're talking about when it comes to finances. So it's quite interesting that when you get in there and the students that are interested in finance, they have a lot of great questions. They want to learn about, what are the most tax efficient accounts I can use? What are the hot topics today in the economy? But they do come from a sort of gamified way of life where they always have these sort of stock trading clubs where they'll have this faux account where they can make trades, and they sort of gamify the process, and they try and beat their peers at making money in a 30-day period, which is fun, of course, right? But it's not investing. It's more speculating or gambling or whatever you want to call it, because these are 15-year-olds that are buying Disney or Coke or Walmart or whatever. With very little knowledge of how technical trading works or anything, which is a bit dangerous. And I try and push them away from that and go out, instead of figuring out who can make the most money in 30 days, let's figure out where we think the big moves are going to happen over the next 10 years.
Do you feel like there's any validity in those kind of like trial accounts where they can kind of trial out the stock market? Or are they just kind of meant for fun and exploration, but not really teaching actual like financial literacy of stock trading and kind of long-term buy and holds?
I think if the sort of exercise is done over a period of at least 6 months to a year, it can have some merit, because the students can see the volatility in the stock and how it might go down for a few months, but then it might rocket back up a few months later. And there's sort of this, rocky road that gets you up to your goals. But on a shorter term basis, whereas weeks at a time, it's a sort of dangerous concept, because it gets them used to, buying and selling all the time. And, some of these accounts, they don't even show the transaction fees that might be involved with that, the tax implications that might be involved with that. And it can be a little bit of a dangerous precedent setting. But it's good to get them involved into the world and use trading platforms and be able to see the tickers and be able to see how the world works. And it becomes all less intimidating when you have, real life experience working at these companies.
Yeah, absolutely. And I appreciate the honest response too, right? Like if you had said, no, all the kids at my school are, trading stock options and becoming financial advisors, I definitely want to know what school you are sending your kids. That's phenomenal. So Doug, if you had, I know there's been this kind of consensus that there really isn't a curriculum in place to kind of teach kids about all the things that are financial literacy in a way that they actually understand and actually care about. So if you had kind of a magic wand and say, hey, I have this year-long curriculum to teach kids, the basics, the more advanced steps, how to really kind of dig your teeth into investing, but not be overwhelming. What kind of, general concepts would you teach your kids to kind of ease them into the topic?
For sure. And that's effectively, in a nutshell, what I did in my book was chapter 1, foundational concepts like the compounding, the inflation, the opportunity cost. Chapter 2 goes into, setting an end game for yourself, figuring out where is it I actually need to go? What does my lifestyle look like in 30, 40 years? And how do I inflation adjust that? So I know that when I retire and groceries are $1,000 a shop, wow, I need to get to $5-10 million, something like that, realistically by the year 2070. And that's sort of an eye opener. And then how do I work back from that, figure out contributions, growth rates, risk I need to take, to bring to reality what I need to do to accomplish those goals and what will happen to me if I wait too long. And then, what are the asset classes that you can use to accomplish those goals? What are the high level overviews of real estate and stocks and bonds and mutual funds and ETFs and art and collectibles and crypto? And there's a whole plethora of ideas out there. How do I diversify? How do I use debt? I mean, so many parents just say debt is horrible, never take it on, pay it off as soon as you can. Sort of the Dave Ramsey approach, right? But double-edged sword, right? Debt is a tool. It's on the balance sheet of almost every billionaire out there. And then going through, some basic understanding of business and balance sheets and income statements, cash flows, how do these things work? And yeah, just sort of, the high levels that gets them excited, because then it brings questions. It brings follow-ups and more research, and it'll just sort of snowball from there.
Yeah, that's a great point. And I think the same thing can be said for any novice investor, right? It doesn't have to necessarily be kids per se. No, that's kind of the topic that we're talking about. But that same kind of idea of understanding compound interest, of understanding opportunity costs, of understanding real estate cycles and debt, that is the case for any kind of investors who's getting into real estate, whether you're 10 years old, 20 years old, 50 years old, 70 years old. Right? Those kind of concepts are paramount to really understanding your investment portfolio and kind of where you want to be. And I love what you said about reverse engineering where you want to kind of go and what you have to do during these kind of early stages to really set yourself up for that success. So
it's math, right? At the end of the day, it's just a math equation. If you wait till you're 45 to save for retirement until you're 65, you're going to be putting away the entirety of your paycheck every month and then some to get even close to where you want to be. So make it easy for yourself. Make it, a couple $100 a month for 50 years, $1 million.
Yep, exactly. And the key part of that is to invest that money, right? To not just save it, right? Because no one's ever saved their way to retirement. We've heard that saying so many times, right? But to actually take what seems like a nominal amount of 100, 150, 200, bucks a month and actually invest that can really have that compound interest and really have that effect. And, I'm very much a visual learner. That's one of the first ways that I learned about compound interest was to just look at a graph. Or even there was a story, I don't know how familiar you are with the story, but there's this like Chinese proverb story of this farmer who has a grain of rice on a chessboard or a checkers board. Have you heard that? Have you heard the story at all?
I don't think I have. No, I'd love to hear it.
It's a good one. So the farmer comes to essentially the emperor of the kingdom, and excuse me if I messed up the story, but he comes to the emperor of the kingdom, and the emperor says, okay, I can pay you in terms of the number of grains of rice that you produce. And the farmer says, what I'd rather do is start on the first square and I'll put 1 grain of rice. And on the second square, I'll put 2 grains of rice, and then 4, and then 8. And so essentially he's compounding his return. And so by the time that you get done with the very last square, whatever it is, the 32nd square, you're up close, I think, $1 million plus easily in terms of what he would have been paid. And so I think that really kind of, at least for me, brought home the power of compound interest, is that it seems like the growth is minimal at the start, and then all of a sudden it starts to hockey stick, right? They kind of like the hockey stick where you really kind of see exponential growth. And that's really where people say, hey, how'd you get, wealthy so quickly? Some might say like a matter of 10 years, right? And it's because of the compound interest that eventually took effect. And there's that kind of that tipping point almost where those exponential returns really start to compound on top of each other and really can grow quite fast.
100%, yeah. And the rate at which things compound is all a function of diversification. I mean, if you could have a 20%, 30%, growth rate every year, then your money is doubling every couple of years and you're in pretty good shape. But if you put it in a 3% GIC, you're taking decades and decades to get to the same place. So that's the most challenging thing, is the balance of figuring out the math of, this is the lifestyle I want in 40 years. I need this much to make it happen. And I need that to grow based on the income I'm making. Then I need to hit an 8%, average growth rate every year. How do I get there? I can't do it by just having fixed income and low risk stuff. So how do I balance out some more risk that lets me sleep at night, and isn't over the top, but yeah, has some exposure to equity, has some exposure to real estate, maybe some minimal exposure to some sort of penny stocks and cryptos and the real sort of high growth stuff. But yeah, it's math.
Yeah, and we've mentioned this before too, right? But and I know you just mentioned this, Doug, but the kind of baseline benchmark that you're trying to hit is inflation, right? A lot of people think, oh, if I made a 10% return, I made a 10% return, but that may not necessarily be the case, right? If you're not factoring in inflation, you really should be looking at kind of your net return, given the fact that your money is degrading day by day, month by month, year by year. So yeah. With that, what kind of tips and strategies can parents or educators use to kind of really create this supportive learning environment that really kind of encourages financial curiosity? Because I think that's really one of the powers of teaching these strategies and these topics kind of early on, is that kids have an inherent curiosity for life. And this is one of the kind of the major topics. I'm curious how you kind of create an entire environment where it's not just a one-off topic once a week or a book every other month. How do you kind of really build that foundational mindset almost for kind of setting them up for success for many years to come?
For sure. And it comes down to parents. Until we get, educational curriculums to put these topics into the classroom, which they're not right now, it really comes down to the parents doing this with their own kids and practical everyday conversations with your kids that sort of weave in a financial lens to them is sort of good to build that mindset early. The examples of going to the grocery store, going to the toy store, going to the movies, and talking about, prices and talking about, how you can't have this toy that costs $100 because, hey, I don't think it's good value, or, hey, that's X hours of mom's salary that she'd have to work for this many hours to be able to afford just that one toy. Putting these kind of perspectives in place, because the kids have no concept of where money comes from and how hard it is to earn and how hard it is to keep. So you have to make it real to them. So they go, oh, wow, mom has to work a whole day to get a Lego? That doesn't seem to make sense.
Right. And especially if you're using their own allowance or money that they're getting too, right? It's one thing to trade stock options on this hypothetical platform when you have 10,000 of spare cash. It's a little bit of a different story when you're using your own budget, putting 30% aside for savings, 10% for investments, or however you want to break it up. It's really poignant, really, to make it useful and important to them, right? Because I think that's where a lot of any topic that you're trying to teach somebody, if there isn't any relevance to them, it's really hard for them to understand it, let alone kind of utilize it in their day-to-day interactions.
You really have to, right? I mean, so many parents now, to no fault of their own, never got a financial education and became part of this sort of consumer culture and convenience culture. And, I just cringe when I hear stories about, parents that go home with a couple of young kids and they had a hard day and they just decided to get, DoorDash for dinner, right? And the kids just think, oh, it's just easy to order dinner. That's great. But I always tell my kids, I will almost never use DoorDash because it comes with fees, it comes with markups. And I actually once did this exercise to show my kids this. And I went and I did a fake order on DoorDash of a McDonald's meal, right? Sort of Big Mac meal. And it was something like, I don't know, $18 or $20 with delivery. And then I said, that meal is some French fries, it's a burger, it's a Coke. what if we made that ourselves? I can go to the store and make all the stuff myself for $3. So is a 600% markup for convenience worth it to you? Some days it might be, but you have to realize like it's not good value. And people waste money all day long on these convenience culture decisions. And if you can get your kids ingrained in going, wow, I can have the same burger for $3 that I, could get for 18 from McDonald's, the 15 bucks I save, invest it, right? Put it away. This is how I get wealthier. And then just they grow up in this environment of like thinking about every decision from a financial lens, and they're just smarter about it as they get into the real world, and they're more conscious about decisions they make and what it means, and as opposed to coming from a family that has no education on finances and bad habits, and they end up in the same boat as their parents with not enough money to retire with, too much debt, and bad habits.
Yep. Who would have thought that McDonald's could teach kids financial literacy? But there you go.
Publicly traded company, right? You can go on their financial statements even and look at their cost of goods sold, and you'd be shocked.
Yep. That's wild. Yeah, I saw this guy who was crazy to me. He was ordering DoorDash 3 times a day, and went to review his statement. He'd spent close to, I think, $30,000 on DoorDash throughout the year, and that is crazy to me. Absolutely exorbitant.
I hope he makes $1 million a year, because
I know, right? Because if you're spending that much, if you have $1 million, then what's 30 grand? But yeah, wild story. Awesome, Doug. As we kind of come to the close, any other last bits of words of wisdom or pearls for our audience, especially as they kind of prep to have this conversation with their kids and really kind of set their kids up for financial success? Because I started off the whole conversation saying that it's not so much, hey, here's a lump sum of $1 million when I pass away, have at it. It's really about instilling long-term, mindsets about smart financial decisions, analysis. So we'd love to kind of hear any kind of last golden nuggets before we sign off.
Sure. Yeah, I think it's just really important to consistently and pragmatically talk about money and finance and investing with your kids, even when they're 5, 6, 7 years old. As I mentioned earlier, some of these early concepts around movies and Disney and shopping, and as they get older, make it more and more complex, and involve them in these conversations, make them feel like an adult. Don't dumb things down. And by the time they get out of high school, at that point, they know enough that they have a foundation. And I named my book A Fighting Chance, which is really, my attempt to give students a fighting chance at financial success, because right now most of them don't, and they're not being given anything. And it is up to the parents and educators to make this happen. So, treat your kid with the expectation that they're going to be able to absorb a lot of knowledge and do your best, and give them that financial knowledge that they need to be successful. Otherwise, they're going to have a real tough time.
Yep. You heard it here first, folks. Go teach your kids, teach them financial literacy. They're waiting, they're eager, they're curious. Don't do them a disservice, right? That's kind of the ultimate goal.
Yes.
Doug, I appreciate the time, appreciate the expertise. This is phenomenal. If people want to kind of get a hold of you or reach out to you, where can they find you?
Yeah, I've got a website, which is fightingchancefinance.com. You can follow me on Instagram. I've got a blog, all kinds of free resources for people to take a look at. And yeah, if you've got a student in high school, early university, 16 and up, give them a copy of my book. It's geared right for them.
Awesome. Appreciate it, Doug. Thanks so much.
Yeah.